Welcome once again to our commerce classroom. In this session, we will discuss about cost of capital. Cost of capital. We know cost of capital simply refers to the cost of obtaining funds. All of you know about investment decision, financing decision and dividend decision. In our investment decision, we know how much amount of capital we require for investment in fixed asset and current asset. We have to raise that capital from different sources. The decisions regarding selection of different sources of funds, we know that decision is our financing decision. At the time of taking the decision, we know if we raise equity capital, preference share capital or debenture, bank loan, whatever may be our sources of finance, we have to pay them something in return. In case of equity share capital, we have to pay dividend. In case of preference share capital also, we have to pay the specified rate of dividend. In case of bank loan or debenture, we have to pay interest. Actually, that return to our suppliers of capital is our cost of capital. Then we have one definition here for our cost of capital. That definition is given by John J. Hampton. The definition is this: the cost of capital is the rate of return required from investment in order to increase value of firm in the marketplace. I repeat, according to John J. Hampton, cost of capital is the rate of return required from investment in order to increase value of firm in the marketplace. As per this definition, the cost of capital is the rate of return from our investment, minimum rate of return we have to get from our investment in our fixed assets, current assets or other security portfolios. We have to get a minimum return from that investment. That return is our cost of capital. That return must be sufficient to increase the market value of our firm. This is the meaning of this definition given by John J. Hampton. Then we can define this cost of capital from the point of view of firm and then from the point of view of investor. From the point of view of our firm, the cost of capital is the rate at which a firm raises capital to invest in various projects. I repeat, from the point of view of firm, cost of capital is the rate at which the firm raises capital to invest in various projects. Then from the point of view of the investor, cost of capital is the rate of return which investors expects from the capital they invested in the firm. It is actually the rate of return expected by investors for the investment in the firm, for the supply of capital to the firm. Then alternatively, we can say that cost of capital is the weighted average cost of various sources of finance used by the firm, that is equity, preference and debt capital. Then we discuss about how can we determine cost of capital. We know we raise debt capital, we raise equity capital, we raise preference capital, and then also we have certain retained earnings at the end of our accounting period in our hands. Here we determine the cost of capital of these various elements of capital. Firstly, we start with the cost of debt. Cost of debt. In case of cost of debt, cost of irredeemable debt. Firstly, we discuss about cost of irredeemable debt. That cost of irredeemable debt also we classified into before tax cost and then after tax cost. In case of before tax cost of debt, we represent that before tax cost of debt by the symbol KD. KD is equal to interest divided by net proceedings into 100. That is what our formula in case of irredeemable debt before tax. Interest divided by net proceeds of debt into 100. Here this interest we know, if we raise bank loan, if we issue debenture, whatever may be our source, we have to pay interest to the supplier. Then here net proceeds. Net proceeds of debt is equal to issue price minus flotation cost. In order to raise debt capital, we have to pay certain expenses, we have to meet certain flotation like expenses. Then so net proceeds is equal to our issue price minus this flotation cost. Then we come to after tax cost of debt. So formula, in case of after tax, we will get the benefit of tax. So we have to adjust that tax element in our formula. So our formula changed in such a way. Cost of debt is equal to interest into 1 minus tax rate 1 minus T divided by net proceeds into 100. Here our formula, after tax cost of debt, interest into 1 minus tax rate divided by net proceeds into 100. Here we explain this cost of debt with the support of an example. Our example is this: X Limited issued 2,09% debentures at a premium of 10%. Flotation cost are 2%. The tax rate applicable is 60%. Compute cost of capital. This is our example, our question. Then its answer we know the formula. After tax cost of debt formula: interest into 1 minus tax rate divided by net proceeds into 100. Here interest 9% debenture, so 2 lakh into 9%, that comes to interest 18,000. Then net proceeds, here we issue our debentures, rupees 2 lakh debentures at a premium of 10%. So 2 lakh into its 10%, that comes to 20,000. Then 2 lakh plus 20,000, 2 lakh 20,000. From that 2 lakh 20,000, we have to deduct this flotation cost 2%, 2 lakh 20,000 into 2%, that comes to 4,400. So our net proceeds is equal to 2 lakh 20,000 minus this 4,400, that is equal to 2 lakh 15,600. So we apply these information. Then we apply these informations in our formula. Interest 18,000 into 1 minus T, tax rate is 60%, so 1 minus 0.6 divided by our net proceeds we calculated 2,15,600 into 100, that is equal to 3.348%. That is what our cost of capital in case of this redeemable, in case of this irredeemable debt after tax adjustment. Then next we discuss about cost of redeemable debt. Cost of redeemable debt. This cost of redeemable debt also we divided into 2 categories: before tax cost of debt and then after tax cost of debt. Firstly, we discuss about before tax cost of debt. Cost of redeemable debt. We know the peculiarity of redeemable debt. We have to pay back that amount collected from our debenture holder after a specified period of time, 5 years, 6 years or 10 years, depends on the terms and conditions of that debenture. Then before tax cost of debt, KD, we represented it by KD, is equal to interest plus 1 divided by n, 1 divided by n number of years, into RV minus NP. RV, redeemable value of debt after the end of 5 year or 6 year or 10 year. For the completion of that period of time, we have to pay back that amount at the time of redemption of debenture. How much amount we paid to our debenture holder, that amount is our redeemable value. RV minus NP, we know net proceeds. Net proceeds is equal to, already we calculated, we know how to calculate it. Then divided by half of RV plus this NP, half of RV plus NP into 100, that is what our formula. Then after tax cost of debt, its formula we have to adjust here the element of tax. So our formula, interest into 1 minus T, 1 minus T, 1 minus tax rate plus 1 divided by n, RV minus NP, all divided by half of RV plus NP into 100. That is what our formula in case of this after tax cost of debt. Then we illustrate it. Example, X Limited issues 10-year 9% rupees 2 lakh debentures at a discount of 10%. Here we are issuing debentures at a discount of 10%. Then flotation cost are 2%. The tax rate applicable is 60%. Compute the cost of debt. Here our formula we know interest into 1 minus T plus 1 divided by N into RV minus NP all divided by half of RV plus NP into 100. Here interest we are issuing rupees 2 lakh debentures, interest rate 9%. So interest is equal to 2 lakh into 9%, that comes to 18,000. Then next we know duration, we are issuing the debentures for 10 years. So N is equal to 10. Then RV, redeemable value, RV is equal to 2 lakh. Then NP, net to proceeds. Here we are issuing 2 lakh debentures at a discount of 10%. So 2 lakh minus 10%, 2 lakh. That comes to 1,80,000. 2 lakh minus it's a 10%, 20,000. 2 lakh minus 20,000, that is equal to 1,80,000. From that 1,80,000 we have to deduct this flotation cost 2%. 1,80,000 into its 2% we know 3,600. So our NP is equal to 1,80,000 minus 3,600, that is equal to 1,76,400. Then we apply these informations in our formula. We will get the answer. Our cost of debt 5.079%. 5.079%. Then secondly we find out the cost of preference share capital. Cost of preference share capital, we know at the time of issuing preference share capital we already stated the dividend along with the name of preference share. 10% preference share capital, 11% preference share capital, 9% preference share capital. We know we already seen this percentage along with the name of this preference share capital. So we know dividend is already stated. Dividend in case of preference share capital is already stated. Then cost of irredeemable preference share. Firstly we calculate cost of irredeemable preference share capital, that represented by the symbol KP. Cost of irredeemable preference share capital is equal to DP divided by NP into 100. DP we know preference dividends divided by NP net proceeds. DP divided by NP into 100, that's what our formula. Then secondly we calculate cost of redeemable preference share capital. Cost of redeemable preference share capital, we have to redeem this preference share after the expiry of a specified period of time, say 2 year, 3 year, 4 year, 5 year, etc. Then here our formula DP means preference dividend, DP plus 1 divided by N, then RV minus NP divided by half of RV plus NP into 100. I repeat, the cost of redeemable preference share capital is equal to preference dividend plus 1 divided by duration of preference share, 1 divided by N into RV, redeemable value of preference share after the expiry of the duration, RV minus NP, net to proceeds at the time of issue of preference share, divided by half into RV plus NP into 100. Then we illustrate it. A company issued 10,000 10% preference shares of rupees 100 each, redeemable after 10 years at a premium of 5%. The cost of issue is rupees 2 per share. Calculate the cost of preference share capital. Here our preference dividend 10% preference share capital, issued 10,000 preference shares of rupees 100 each. So amount comes to 10,000 into 100, that is equal to 10 lakh. 10 lakh into 10%, that is equal to 1 lakh. Here preference dividend is equal to 1 lakh. Then number of years, the duration of preference share 10 years. So N is equal to 10. Then redeemable value, we are going to redeem this debenture after 10 years at a premium of 5%. So 10 lakh into its 5%, that comes to 50,000. 10 lakh into 5%, 50,000. So RV, redeemable value, is equal to 10 lakh plus this premium 50,000. So 10 lakh 50,000. RV is equal to 10 lakh 50,000. Then net proceeds we are issuing these preference shares 10,000 into 100, that is equal to 10 lakh. From that 10 lakh we have to deduct the issue cost. Issue cost rupees 2 per share. Here we are issuing 10,000 shares. So 10,000 into 2, that's equal to 20,000. So our net proceeds is equal to 10 lakh minus 20,000, that is equal to 9 lakh 80,000. When we then we apply all these informations in our formula. 1 lakh plus 1 divided by 10 into 10 lakh 50,000 minus 9 lakh 80,000, all divided by half of this 10 lakh 50,000 plus 9 lakh 80,000. Then we get our cost of preference share capital, that is equal to 10.54%. 10.54%. Then thirdly, we discuss about the computation of cost of equity share capital. We can use different methods for the computation of this cost of equity share capital. We start with the dividend yield method or dividend price ratio method. Our first method, dividend yield method or dividend price method. In this method, cost of equity in case of fresh issue, we are issuing equity shares now. Cost of fresh issue, cost of equity capital is equal to dividend divided by net proceeds into 100. Dividend divided by net proceeds into 100. Here dividend here means expected dividend per share. K is equal to D divided by NP into 100. Here D expected dividend per share and NP we know net proceeds per share. Then cost of equity share capital, in case of existing share. In case of existing share, in that case, cost of equity share capital is equal to D divided by MP into 100. D dividend expected dividend per share, MP here market price per share into 100. Then our second method for computation of cost of equity share capital is dividend yield plus growth. In dividend method, dividend yield plus growth method, dividend yield plus growth in dividend method. Here our formula, cost of equity capital is equal to DE divided by NP plus G. DE divided by NP plus G. DE expected dividend at the end of the year, expected dividend at the end of the year, then NP net proceeds. Then we can expand this formula in such a way, D0 into 1 plus G divided by NP plus G. D0 into 1 plus G divided by, all divided by NP plus G. Here D0 previous year dividends, G growth rate in dividends. If we substitute this NP by MP, our formula K is equal to D divided by MP plus G. Then we illustrate it. The shares of a company are selling at rupees 40 per share, market price 40 per share, and it had paid a dividend of rupees 4 per share. The investors market expect a growth rate of 7% per year. Compute cost of equity capital. Here we firstly write our formula. We know K is equal to D0 into 1 plus G divided by NP plus G. D0 rupees 4 per share given in our question. The shares of a company are selling market price of rupees 40 and paid dividend of rupees 4 per share in the previous year. So D0 is equal to 4, MP is equal to 40. The investors expect a growth rate of 7%. So G is equal to 7%. That is equal to 7 divided by 100, 0.07. Then we apply these informations in our formula. D0 into 1 plus G divided by MP plus G. D0 4 into 1 plus this growth rate 7%, that is equal to 0.07, all divided by market price 40 plus a growth rate 0.07, then we get 0.177, that is equal to 17.7%. Then our third method for computation of cost of equity share capital, earning yield method or earning price ratio. Earning yield method or earning price ratio. In that case, the cost of equity capital is equal to earning per share divided by net proceeds, EPS divided by NP. The cost of existing equity capital in the place of NP we apply this market price per share. So our formula EPS divided by MPS. Then our fourth method, realized yield method. When the future dividend and market price are uncertain, it is difficult to estimate the rate of return on investment. In order to overcome this difficulty, the average rate of return actually realized in the past few years by the investor is used to determine the cost of capital. I repeat, in case of realized yield method, when future dividend and market price be now uncertain, in most of the cases, it is difficult to estimate the rate of return on investment. So, in order to overcome this difficulty, the average rate of return actually realized in past few years by the investor is used to determine the cost of capital. Then, another method, a capital asset pricing model, CAPM. This is an important method. Capital asset pricing model, CAPM. This CAPM divides the cost of equity into two components. Our cost of equity capital has two components: risk-free return available on investing in government securities and an additional premium for investing in particular share. Our cost of capital it has two components. First component, risk-free return available on investing in government securities. If we are not going to invest in equity shares, if we invest in government securities, we have no risk there. We will get a return. That is what is risk-free return available on investing in government securities and additional premium for investing in particular share. If we invest in a particular share, we have to take a risk. After adjusting that risk, we want to estimate an additional premium amount. And second portion, an additional premium in investing in a particular share. This risk premium includes the average rate of return on the overall market portfolio and the beta factor, here risk factor of the particular investment. Our formula under this CAPM method is cost of equity capital KE is equal to RF plus BI into RM minus RF. I repeat, KE is equal to RF plus BI into RM minus RF. Here RF risk-free rate of return, BI beta risk of investment I, BI beta of investment I, then RM average market return. Then we illustrate it. You are given the following data relating to a rate of return 11%. Beta coefficient of the firm is 1.25. Compute cost of equity capital under CAPM, assuming market rate of return is 15% next year. Our formula, cost of equity capital is equal to RF plus BI into RM minus RF. Here RF already given in our question, RF 11% risk-free rate of return. If we invest in government securities or other securities, we will get 11% return. Then our beta factor is given 1.25, our risk factor 1.25. Then RM already given in our question, average market return. Average market return in our case is 15%, and then so RM is equal to 15%, then RF we already given 11%. So K is equal to 11% plus 1.25 into 15% minus 11%, that is equal to 11% plus 5%, that is equal to 16%. That is what our cost of equity capital under CAPM. Then we discuss about cost of retained earnings. We know the cost of retained earnings is an opportunity cost to be measured in terms of income foregone by shareholder that they could have earned by investing in some alternative opportunities. We know in case of retained earnings, shareholder will not get dividend. If he got dividend, he can invest that dividend, that amount in some other productive sources, and he will get a return. Then here the cost of retained earnings is almost equal to the cost of equity. However, shareholders have to incur flotation cost for new investments. If shareholder got that retained earnings by way of dividends, he has to invest that amount in some other sources. For that investment, he has to incur flotation cost and pay taxes when he received dividends, which they need not pay when earnings are retained. Then the cost of retained earnings will be cheaper than cost of equity capital. We already said that the cost of retained earnings is almost similar to that of cost of equity capital. From that cost of equity capital, we have to deduct this personal tax rate and flotation cost. So our formula, cost of retained earnings is equal to cost of equity capital KE into 1 minus F, 1 minus flotation cost into 1 minus T tax rate. Okay, so our formula KR is equal to KE into 1 minus F into 1 minus T. KR cost of retained earnings, KE cost of equity capital, F flotation cost, and then T personal tax rate. By using this formula we can calculate the cost of retained earnings. Then weighted average cost of capital. Weighted average cost of capital. Weighted average cost of capital is also known as overall cost of capital or composite cost of capital or average cost of capital. The formula to find out is WACC, weighted average cost of capital. K is equal to K0. K0, the cost of this weighted K0 represents weighted average cost of capital. K0 is equal to sigma XW divided by sigma W. Sigma XW divided by sigma W. Then X is equal to cost of specified source of fund. Then W is equal to weight in proportion of each source of fund. Then we discuss marginal cost of capital. Marginal cost of capital. Marginal cost of capital is the cost of additional funds to be raised. It is the weighted average cost of new capital calculated by using marginal weights of additional funds. I repeat, marginal cost of capital is the cost of additional funds to be raised. It is the weighted average cost of new capital calculated by using marginal weights of additional funds. I think the cost of capital and the computation of cost of capital explained here is clear for all of you. We will meet again. Till then, goodbye.